0 return. You can do better than that, number one. Number two, we're competing with institutional money. Now, typically, institutional money, hey, you folks on YouTube, I just saw you pop in, and hopefully you guys are all working, getting this going now. So please give me some questions, feedback, thumbs up, likes, shares, etc. over on the YouTube side. I'm not sure what happened there, but we're talking about why you should not overpay for multifamily and why a lot of people are overpaying and how not to avoid it. So we talked a lot about already about why multifamily is the perfect investment. You can go watch the video or check out some of my blogs on BiggerPockets. But the first reason people are overpaying is international money is coming into the U.S. at record pace, and a lot of them are willing to accept a very low return. So don't do that. And if you're competing with them, don't overpay just because you want to buy the asset. Number two, institutional money. Now, institutional money has been focused on the coasts, typically New York, LA, San Francisco, locations like this, but they've been often coming in now to the middle of the country, okay? So institutional money is coming in, and that's not all institutional. I'm just saying there's more and more institutional money that's coming from the coast inward. Number two, they're going to smaller geographies. It used to be they wanted to be in the primary cities, New York, Miami, LA, San Francisco, and now they're coming to secondary, tertiary, and even smaller cities. We're having to compete with institutional money in places like Lexington, Kentucky, Louisville, Kentucky, Knoxville, Tennessee, Chattanooga, institutional money. And some of that money is from life companies, life insurance companies, or others who are willing to accept a small, stable return, and they're willing to live with that, and they're not looking to hit it out of the park. So they might be willing to live with a 3 or 4% return, and with their leverage, that's just what they need for their portfolio. How can we compete with that, guys? It's not something that you or I want to compete with, and it's a difficult situation for all of us because institutional money is coming into play in markets that we hadn't seen before. So we got international money, institutional money, and IRA money, the first big three I's. Now, you may be a self-directed IRA investor, or you may have a self-directed 401k. Even though there's only like 2 or 3% of the IRA and 401k money out there that are invested in self-directed IRAs, specifically in real estate, it's growing fast. And so I can't put my finger on why this is, but when I talk to institutional investors, IRA investors, I realize that they don't always, don't always, they're not always as critical with where and how they get their investments, and where and how they invest, and how they evaluate their returns. I don't know why, but it seems like they think, well, here's my money that I have in my bank account. It'd be really painful to lose money here. Here's some money I have in an IRA. I can take a little more risk with that. So IRA investors are coming in in record numbers, and the problem is sometimes they don't always evaluate as critically. So my counsel to you, my friends, is evaluate it really critically. If you have IRA or self-directed 401k money, treat it just like any other money. Treat it like you would if it was your grandmother's money. I talked about the grandma rule in one of my upcoming posts, and we'll talk more about that in the future. But if this was your grandmother's last $50,000, would you put it into this investment? Well, nobody should invest their last $50,000 in any one investment. But if they were investing, I learned that rule from some of my heroes in investing. It's a company called 37th Parallel, and there are my mentors in multifamily investing. So self-directed IRA money, if you have it or if you're competing against it, be careful. Fourth, 1031 exchange funds. There is record amount of money that's being cashed out of investments right now, commercial or other real estate investments, and people are looking to reinvest it. Now, saving 10, 15, 20, 25% on their taxes is super appealing, depending on how far their basis is paid down. And so that appeal means that they're willing, honestly, legitimately willing to overpay a little bit for assets. Now, when I say legitimately, I mean they have a good reason. They want to avoid a tax. I get that. And so they might be willing to make the high offer on a property because they're a 1031 exchange investor. But I'm going to say this, if you're a 1031 exchange investor, if you overpay, especially if the leverage is on a non-fixed rate debt, you might find yourself in trouble when it has to be refinanced in a couple of years. So don't overpay, whether you're a 1031 exchange investor or if you're bidding against a 1031 exchange investor and you know that. Don't let them force you to overpay on an asset. I'm going to get a quick drink here. So reason number 5 people are overpaying is some of them are newer investors or newer syndicators. There's been a record amount of mentoring, coaching, frenzy in, within BiggerPockets and outside of BiggerPockets, and there's a lot of new investors, and some new investors might miss something. They might make a mistake. So if you're a newer investor, get coaching, get help, get somebody to look over your shoulder and help you with your investments. And don't just go out and invest your investors millions of dollars in something that you're not 100% sure of. You can't be sure of the outcome, but you can be sure of everything that you put in. Make sure. I could spend a long time telling you stories of times we invested in years past or didn't invest more recently because of due diligence. I did a session this Saturday talking about why I just walked away from a $10 million deal because I found something that, for whatever reason, nobody else had seen in this investment. And so be careful. If you're newer, make sure a lot of people have looked over your shoulder. By the way, don't let your banker, and especially don't let your real estate broker tell you what something's worth, okay? It may not be worth what they say. Even the bankers, who are generally conservative, sometimes overbid on these type of things. The sixth reason people are overpaying is there's a name of a book. I don't actually have the book. And so if somebody finds this book on Amazon, post it for everybody to see here. I think it's called This Time It's Different. Sound familiar? Have you heard people say that? Have you heard yourself say that? This time it's different. Yeah, there have been recessions over, many decades, and people say, well, this time it's different because, and if you were here 20 minutes ago, I went over all these demographics. There's the millennials, there's the immigration group, there's the baby boomers who are renting more than buying. And so we think all this, and our logic overrides our mind, overrides our heart, and tells us this time it's different. It's not probably different this time. It's probably going to go just like it went other times. And if you don't be careful, you're going to get burned. Don't believe the lie that this time it's different. Seventh and final reason people are overpaying. There are people out there who are knowingly doing deals they shouldn't, and they're using your investor dollars to do that. And it's tempting for them because they make a fee on the front end. They make a fee on the back end. They get a portion of the deal of ownership. And yeah, they have to work really hard to get that, but they are knowingly overpaying for deals. It's kind of like the newbies I mentioned earlier who are innocently overpaying. These people are knowingly overpaying. And if you're a passive investor or if you're partnered with them, don't let them tell you this time it's different. Don't let them tell you that rents are going to keep going up at 5 to 10% a year forever. Don't let them tell you that rents should go up triple what the cost of running the facility is. Look critically, think about it, and don't believe the lie that this time it's going to be different than other times. So we just talked about 7 reasons people are overpaying. Hey, Richard. Hey, Charles. Hey, my mother. Richard from Japan. Thank you for joining us. Bakersfield, Frank, John, Omid. Thank you. The sound is really soft, he said. Okay, is this better? Somebody tell me if the sound was a problem, number 1, and number 2, if this is better. Now the mic's in my face, but that's probably good for people who are watching because it's blocking part of my face. Okay, my kids would say that to me at least. So 7 reasons people are overpaying. Number 1, international money that is willing to take a lower return. Number 2, institutional money that's willing to take a lower return. 3, self-directed IRA money. 4, 1031 exchange money. 5, newbies and people who are newer who are making mistakes. 6, people who are saying this is different. This time it's different, and it's not. At least I don't think so. And number 7, sharks. Did I call them sharks? People who are knowingly taking investor money and overpaying for assets. Okay? So how do you avoid this? Let's talk about that, and we're going to wrap up in a few minutes and take some questions. So if you've already asked a question, feel free to copy and paste it back in again, because in about 2 minutes, I'm going to wrap up and take questions. So how do you avoid overpaying? Well, number 1, just don't do it. Have you seen that Bob Newhart thing where the lady said she's scared of being buried in a box? And he says, like, he's the psychologist, and he says, well, stop it. And he's like super unhelpful. It's really funny, but stop it. Just don't overpay. Okay. Number 2, ask hard questions. Ask the syndicator, ask the sponsor, ask the broker hard questions. Number 3, go visit it in person and drive every major road and even some smaller roads within a 3 or 4 mile radius of the asset. I talked Saturday about the shock of a lifetime that I got when I just did that 1 week ago today. I was in Florida and I canned a $3.5 million investment on a $10 million deal because I drove all those roads and I found some things that were quite surprising, and it was painful, but we did it. So go see the deal in person. Wherever we're at, number 3, analyze really critically. Don't look at best case scenario. I know we all want to believe the best. We're all optimists here on BiggerPockets, right? But we need to be pessimists when it comes to investing. Warren Buffett is like this eternal pessimist, and his default is to say no. So number 4, you need to have a default that says, no, I'm not going to do this deal unless everything lines up and looks right. You know, Warren Buffett has a famous quote, and he says this. He says, I hope I get this right. He says, wait, what did he say? He said something really important, and I'm sure it was really profound. Okay. No, here's what he said. He said, successful people say no a lot. Really successful people say no almost all the time. Be like Warren Buffett. Be skeptical. Be not emotionally involved. Follow your gut. Don't let your brain override with all the reasons you should do something when there's something in your gut's telling you no. I talk a lot about this on other sessions and on my blog posts on BiggerPockets. By the way, are you a BiggerPockets Pro member? If you're not, you really should join BiggerPockets and become a Pro member, because it is, I'll tell you this, it's the best investment I have ever made in, what is it now? 26 years as an entrepreneur. It is the very best thing I've ever done. And that's become a BiggerPockets Pro member. If you want a discount code, I think somebody can post that to the different forums now. I think it's BP1234, but there's a chance I'm wrong. Actually, a good chance I'm wrong. So where were we? So have your default be no. Here's why. You'll never lose money on a deal you didn't do. And I know there's lots of arguments about, well, yeah, but if your money sits in the bank, you're losing money. That's true. But you'll lose more money on a bad deal than you will on getting 2% in the bank. Trust me, I've been there. Did I tell you I have a podcast called How to Lose Money? Yeah. It's a podcast where we investigate stories of people who have lost money, lost time, lost deals, lost family members, relationships, lost, big money from investors. I had a guy who lost $71 million, was our first or second guest on our show. So it's How to Lose Money. I know something about it, and I don't plan to do it again. And I recommend that you don't do it either. But you'll never lose money on a deal you don't do. And also, the other axiom that says sometimes the best investments you ever make are those you don't make. That didn't really make sense, but you get the idea. Okay, last, invest. If you're going to passively invest or partner with somebody else, invest with people who have weathered the last recession. There are people that I've been interviewing lately to invest with that they have actually been through 3 or even 4 recessions. Literally, I met with a company in Southern California last week in the self-storage and mobile home park business, and they've actually been at this 42 years, okay? They've weathered some recessions, okay? They know what to do. And here's the key. It's not important that you can predict the timing of the next downturn or where we are in the cycle. In other words, it's impossible to know when it's going to turn down again unless you have a crystal ball. But it is possible to act appropriately in the moment. So you look at where we are, act appropriately. The problem is it takes a lot of discipline to do that, okay? So my advice is invest in operators or partner with operators who actually have weathered other downturns, and they're in a position to help you and coach you and buy the right assets, get lower debt, etc. I recommend lower debt, lower LTVs as we are going into this really overheated situation. I'm also recommending fixed rate debt that you don't get, take a gamble on the rate being what you want it to be. And I recommend investing with investors who think the same way. Okay, so I'm going to take a breath and read some of these questions. So again, thank you so much for joining today. I am going to look at a few questions on Facebook. All right. Hey, Tiffany from Jacksonville. Hey, Lance, Brent. I live in Dallas, Fort Worth, and they're overpriced. There's a rumor, and I don't want to start like an additional rumor, but there's a rumor that multifamily in Dallas is overbuilt, and it's going to catch up with them really soon. Actually, Green Street Investors said they dropped their ratings for Dallas. So, but Houston, they put to the very top, last report I saw at least. Hey, Basil in South Africa, thanks for joining. Hey, David Omid, sounds like the sound is really soft. Thank you for telling me that. Hey, Brian. Hey, Gustavo. Man, I'm so sorry it was so quiet. I hope you could hear me. Colton, how do you determine which part of your market you should be investing in? I'm in a very hot market at the moment, and stock gets eaten up the same day it is released. You also say, should I look for a different state for better deals? My friends, I hate to tell you, Colton, others, almost every place is overheated in multifamily right now. I can't think of any place that's not. If somebody here will tell me where, a place where multifamily is not overheated, I'd love to know. I live in the Blue Ridge Mountains. I have a couple small towns near me, Lynchburg, Virginia. Shout out for Lynchburg. Roanoke, Virginia. My family has chosen to live here. We love this area. We raised 4 kids here. Been married for 31 years. But enough about me. What do you think of me? Just kidding. So, seriously, it's overheated here. You can't even find a duplex, a 4-plex, a 100-plex that's not overheated even in this area. So I don't know what to tell you. Maximiliano Lopez. Hey, how are you? I think the code is BP1234. And if Zach is on here, he can confirm that. But you can try that. You'll get a discount on your BiggerPockets membership. Kenneth from Germany and Phoenix, thank you for joining. Okay, I'm going to look at a few questions here on the BiggerPockets side. What do you think about Birmingham, Alabama? We actually analyzed Birmingham. The net population migration into Birmingham, which we take it very seriously, was not strong. It wasn't strong in Birmingham or Mobile. It was a little bit better in Huntsville. Check it out on your own. We were not really super happy with investing in Birmingham. I don't want to knock anybody there, but we were very cautious. Max says, why B and not C? Well, we don't really want to invest in A properties because we have chosen, we feel like the risk is a little bit higher on an A property, and in a downturn, people are more likely to walk away from the A's and get into B properties. C properties, on the other hand, we feel like the tenant issues and tenant risk is so much higher. And even if you do value add upgrades to a C property, it's hard to raise the rent. So that's why we've chosen not to do C properties. William says, would you buy a multifamily home if you knew you were moving states away within the next 8 months? That's a specific question. Thank you. William, I would, because we always use property managers anyway. And so I'd find a fantastic property manager. If you're in a market with 300 to 400 or more thousand people, let's say 500,000 people or more, I just contradicted myself. But 500,000 or more, you should be able to find multiple good property managers. You want to make sure you get more than one in case one goes bad, and you can use them to manage your property. Sean says, do you think Tampa Bay is overbuilt at the moment? Well, I don't have enough information on that. I don't think I mentioned to you guys, I don't invest in multifamily, at least in Florida, California, Nevada, or Arizona, because they have such high upswings and downswings. I don't want to add that additional risk. We are really conservative. I mean, look, I look over 40. I'm over 50. And so we're super conservative, being very careful. And so I don't know Tampa. I was just there. I just invested in a self-storage facility near Tampa. I like that area a lot, but I don't know that much about it for multifamily. Okay, I'm going to be looking over here at YouTube. I really appreciate, thanks Danny for your comments. Not sure what happened earlier on the YouTube side. Hey, Jonah. Hey, Raul. Institutional money, Jay Bourbon asked about. Institutional money is life insurance companies or REITs, which is real estate investment trusts, or large family offices, people who are wanting lower risk, stabilized, and they're willing to live with lower return. They're hard to compete with. And so that's the situation there. Hey, Charles, thank you for joining. We were late too on the YouTube side, apparently. Okay, thanks, Darwin. Thanks, I can't read your name, Summer. Catherine, much better. Southwick. Okay, hey, Charles. Okay, hello, everybody. Lots of people here. So Braulio Sanchez says, I'm about to lose a sweet deal because the bank doesn't lend the small amount I need. The property's a mix of residential and commercial. I negotiate it to 30% off the total value. Braulio, have you checked BiggerPockets forums? Have you looked for investors there? Are you part of a real estate investment group like an REIA, REIA in your area? You can check with them so you can find some deals. I'd hate to see you do this, but you could also go hard money and then refinance it later. I would not necessarily do that, but people do it for the right deal. And you can also, if you have experience, you can actually go onto crowdfunding sites and post your deal there. Now, I'm not saying that's easy to do, but I'm saying that people do that, especially with single family flips. Also, check your local credit union. Don't go to the huge banks only. Don't go to the Freddie Mac, Fannie Mae type things. Check with the local credit union or local bank. Sometimes they'll do deals that you can't find anybody else to finance. Hey, Jeremiah, big brother in life, do you mentor? I actually don't, but I do write a lot of articles and I do these live presentations. And I know some great multifamily mentors. If anybody wants to reach out to me on BiggerPockets, I can recommend 2 or 3 that I've met through BiggerPockets myself. And so you can find mentors there. Hey, Los Angeles, Salvador, Jason, investor or agent? I'm not sure of the question. I can tell you I'm an investor. I'm not a commercial real estate agent. So house hacking with a quadplex with a VA loan. Don't know much about it. But if you stay, I think you have to stay there a year for FHA loans. I really believe in house hacking. I think it's a great way to go. Where do we get those reports, Jonah asks? You can find out about, there are 22 criteria we use to investigate or to evaluate a market, and we can't publish those because there are some privacy concerns because we got those from our mentor. But I can tell you that net population migration, you can check that on the U.S. Census reports. You can also check all kinds of U.S. Bureau of Labor Statistics. You can check. Texas A&M Real Estate Center has amazing statistics for lots of markets. So check that out. You can find stuff also by paying for it from Green Street and others. Larry says, any thoughts on South Georgia? No. Charles Southwick says, Boise. I don't know much about South Georgia. I'm sorry. I don't mean to brush that off. I just don't know much about small cities. Charles says, Boise, Idaho is supposed to be the fastest growing city in the U.S. Would multifamily be good there? If you have tremendous net population migration coming into a market and you have low vacancy, high rent increases, fairly high cost to buy a home versus rent, those are good. Those are 4 good factors right there. I don't know much about Boise. I've got a friend there. I should check with him. Actually, the guy who did the BiggerPockets live podcast, the big podcast, July 4th this year, is named AJ Osborne. Really smart guy. He's in Boise. Check that podcast out, by the way. That is an amazing podcast. Hey, Kiri, how do you feel about the New Jersey market? A little concerned about the taxation and the tenant landlord laws. What do you think about Connecticut? I'd probably think the same. Although I don't know, I've never checked it out. DRE. Jeremiah, how much more conservative is the underwriting when in a sideways and potential downturn market? You can't really tell all that stuff until you look into your rearview mirror. You can always tell where you have been. You can't always tell where you're going. And so the problem is even Warren Buffett can't really predict what's going to happen here in the coming months and years. So I would just recommend that you get lower loan-to-value ratios, that you don't overpay, that you don't assume rent increases will continue like they have been, because they might not. Darian White says, what do you think defines a good multifamily deal? There's so much involved. But I would say one thing. Look for cash flowing deals that work even if rent increases stop. I've got a friend in, I can't pronounce this right, San Luis Obispo, did I say it right? California, who was just telling me that he assumes 0 rent increase on everything. And if it works at that, he's got a potentially good deal. Don't count on appreciation to make your deals work. If appreciation's there, that's tremendous. But if it's not, you still want to have a deal that's cash flowing where you're at. Fearless Millionaire says, Camden, New Jersey is where it's at. Gold mine if you know how to sift for gold. Okay, my friend, we finally got somebody who's saying there's a gold mine. Big brother-in-law says, if you can't afford a mentor, what's the best way to learn? You are at the right place. BiggerPockets. Check out their podcast. Check out their books. Check out their, all the different forum posts. There's tens of thousands of different posts and answers to posts. There's hundreds of podcasts. You're at the right place. I literally, and I'm not just saying that because I love BiggerPockets and don't want to get fired, but seriously, it is a great market, a great place to learn. Now, I was just reading ahead. Crypto Kimmy says, how about the Seattle market? I've heard great things about it. I'm kind of wondering if it's just overheated. I don't know. Omar Mustafa says, how about Chicago? I don't know. I think it's really good for self-storage. In certain pockets for multifamily, I don't know. I wish I did. Carl says, how many units do you think are required to live in a property, to have a live-in property manager? About 70 or 80. You said we are looking at one with 48 units with only 60% occupancy. Wow, Carl, that could be an opportunity. Now, you really want to ask yourself critical questions about why it only has 60% occupancy, but that could be an opportunity. Guys, we're going to wrap it up pretty soon. I'm going to try to answer a few more questions. Derek says, hi, I'm from Canada. I am meeting so many people on BiggerPockets from Canada. Hey, Derek, I don't like my local area and will have to move before I start investing. Should I stick with Canada or relocate to the U.S.? I can't really answer that, but you can invest from Canada in the U.S. Just make sure you come on your own and check it out. Maurice says, why don't you like hard money? Well, I just don't like the interest rate. If you get stuck with a long-term hard money deal and you can't get it refinanced and you have 12 or 14% interest rate, that could be a problem. John says, what do you think about the outlook for mobile home park ownership in the Southeast? It's tremendous. There are, I heard the number the other day, there's X number of thousands of mobile home parks going out of business or shutting down every year in the U.S. There's only a handful being built in the U.S., but the demand is at least consistent. It may be going up, but even if the demand was the same and the supply is shrinking every year, it's a great place to be. So mobile home parks is something you're going to see me investing in the near future. By the way, my company is Wellings Capital. I am Paul Moore. I wrote a book called The Perfect Investment. I blog on BiggerPockets, and Wellings Capital, my fund, my organization, is in a situation where we're going to be offering new investments in the coming year in mobile home parks, self-storage, and multifamily. So stay tuned. I'm going to answer a few more questions. Joel says, when doing a deal outside of your state, should I talk to a lender in the property state or my local area? Yeah, both. Just talk to several lenders is what I would say, but definitely local. Most small regional banks want to invest locally. How do you know what the current market cap rate is for an area? Jabu asks, I'm sorry if I'm pronouncing that wrong, probably am. I would say you just get involved in the market. There are statistics out there like Reis reports and REIS and other reports, Green Street, etc., that tell you that kind of stuff. But you just have to talk to a lot of brokers in your local market. Sean Irwin says, has self-storage had the same rent increases as multifamily? Don't get me started on that because I'm supposed to be ending, but that's something I love to talk about. Let me just tell you this one fact. Most self-storage occupants think they're only going to be renting for a small amount of time, like 2 or 3 more months, and I'm going to go take a Saturday and move my stuff out of there, sell it on eBay, take it to the junkyard, or take it to my grandma's house. But self-storage tenants usually stay much longer than they planned. Now, if you have $1,000 a month rent and you get a 6% increase, $60 a month, you might move out. That's $720 a year. But if you have a $100 a month storage unit and you get a 6% rent increase, are you going to take a Saturday? Are you going to load up a rented truck, get your friends, and move your stuff down the street to save $6 a month? Heck no, you're not going to. So self-storage has some advantages over multifamily. Wait a minute, Paul, you said multifamily is the perfect investment. Yeah, I did. And I actually would bank on multifamily for the next 100 years over self-storage. But I'll tell you, at this moment in time, I think self-storage has some advantages over multifamily. There, I said it. So, yay, Cheryl, thank you. Raul says, I'm a university student. Jason said something. Raul, Cincinnati, Ohio is building an entertainment park bigger than Disney. Google it. It's going to be a good one. Now, I'm from the Cincinnati area, Fearless Millionaire, and I did not know that. I'm super interested. I know they have that big Noah's Ark thing south of Cincinnati, which is pretty cool if you like Noah's Ark. It's a full-size replica. I've never been there, but I hope to. Joel says, when doing a deal outside of your state, should I talk to I already answered that. I'm embarrassed. Okay, guys, I'm going to wrap it up. I'm going to stay on these different sites. So if you have asked a question, I'm going to try to answer it in the chat box. You can reach me at somebody asked me for my website. It's wellingscapital.com. Darren, I don't know anything about the Baltimore market. Schizo, right? Anyway, it's wellingscapital.com, or you can better yet reach out to me on BiggerPockets. I'm Paul Moore. It's been great being with you today. Thank you so much. And like I said, I'm going to stay on here and try to answer every question I can. So hang around for 5 minutes if you'd like to. Have a great day and a great Thanksgiving. If I don't see you again before that, take care.